everyone, welcome back to another episode of the Finance Feeds podcast. My name is Nikolai Isayev. I'm editor-in-chief of Finance Feeds. Joining me today is Saul Knapp, who was previously chief risk officer at Rostro Group and is now managing director of futures and options at Rostro Group and Scope Prime, Scope Markets, I think a lot of these different brands, yeah?
Yeah, Rostro is the parent company. Scope Prime, Scope Markets are all underneath the parent company, Rostro.
Awesome. I think you'll agree today's show is completely dedicated to gold. I think the gold markets are somewhat of a surprise maybe the last few years because we've all known it's always been an asset that people go to when they're risk averse, let's say, right? But the trends that we've been seeing in gold over probably, I would say, the last 2 years have been interesting and really kind of phenomenal in terms of where the prices have gone, but then in terms of what's happening in the gold market globally, both from an OTC, CFD, futures perspective, and then just physical gold all around the world. So I wanted to pick your brain on gold.
I mean, we have seen an explosion in sort of gold volumes across, CFD world, the physical world, futures and options. It's just everybody seems to want gold at the moment, especially from the Middle East, Asia. It's just the most popular product that people want at the moment. Whenever we get an inquiry from clients or new business, it normally involves gold.
Mm-hmm. And, I've spoken to quite a few guests in my interviews this year specifically about the gold markets and really people from let's say, the institutional side or the liquidity provision side. And again, in the corners of the different conferences that I attend, people are telling me that besides the fact that, just because gold is, let's say, heading mostly in one direction and it's going up, what I've been hearing is that multiple or some retail brokers are actually getting burned on their gold exposure in terms of where they're positioned in the markets and things like that. Basically, the risk model seems to just simply not being able to hold up, right? And the question to me is, from your vantage point as a liquidity provider, why is this happening? And I've asked this to numerous companies who are in the space. I mean, it seems to me as a layperson, listen, it's almost one directional. So you should probably kind of already estimate where your risk is and apply whatever needs to be applied in your risk model. What's going on?
I think a lot of smaller brokers or some bigger brokers as well don't have the right risk parameters in place, the right risk architecture, undercapitalized, as opposed to us where we are heavily capitalized. We have a big balance sheet. We use only tier one and top tier liquidity providers. We use the exchange for hedging as well. We run stress tests daily, half daily, 3 or 4 times a day sometimes. We don't only stress test our clients, we stress test our LPs, we stress test the actual positions we're receiving from both institutional, retail clients. We have a thoroughly robust risk framework in place, monitored 24/7 or 24/5 if you like. Where I think a lot of these smaller brokers or even some of the more well-known brokers, they just don't have the capability of managing risk like we do.
Mm-hmm. And what do you think has changed in the marketplace that's causing these weaknesses for these brokerages? I mean, again, if we look at a gold chart for the last few years, it's mostly going up. I mean, is it because of the volumes and the demand that's being driven to this financial instrument from traders? Going all the way from the small retail side, but when you packaged that all in together in terms of the amount of volume and interest that goes into it, is it really a matter of managing also volumes for just this one single asset?
Yeah, because it is such a asset in demand at the moment. The concentration risk is what hurts a lot of brokers because they just don't manage how much gold is coming in. As I said, everybody wants to trade gold. So as soon as you have an inquiry from a client or a new broker, it's normally involves a lot of gold. And the problem being that people just don't look at the concentration to a product or to a group of clients
Mm-hmm.
as where we're very careful and very calculated how much gold we take, where we take it, or what area we take it. Client concentration risk, just purely between clients, we focus quite heavily on. I think a lot of smaller brokers just want the business, and to get that business, they have to take the gold at sometimes unforgiving terms. High leverage for a lot of underlying clients causes a broker problem, because if he has to hedge it out himself, they can't get them terms that they're offering out.
Yeah.
So they end up with a capital squeeze and end up running dry of funds.
That's an interesting point that you make, because I feel like over the last 5 years or even longer, there's been this battle for on the retail side for brokerages to be like, in the old days, it was like 250 to 1, 500 to 1. Now it's like 1,000 to 1, 2,000 to 1. And I'm sure there's brokers out there that are offering gold at these leverage levels, which is, I think, just insane. Just even from a trader perspective, like, you should not be trading with that much leverage ever for any asset, right? I,
That's
I
crazy.
hope you would
Yeah,
agree.
yeah. If you look at the exchange on COMEX,
Uh-huh.
on the CME, I mean, gold is about 6% margin, or sort of $20,000 for a one lot. So there's a reason it's a high margin
Yeah, yeah,
product,
yeah.
because it's volatile and it can move around a lot.
Uh-huh.
So if you're offering out high leverage to clients that you can't cover yourself, it's a bit it's crazy, really. As where we never overstretch ourselves, we never over leverage. We have sufficient balances, sufficient capital.
Mhm.
The top tier providers we use are well known. A lot of the stuff we proprietary in-house, sort of managed with algorithmic systems. We have a systematic internalization engine, which takes flow from all different areas and decides where best to route it
Uh-huh.
at the right time. And if you looked at our stats for gold in the last 2, 3, 4 months, we've had
Uh-huh.
100% uptime, no downtime on gold. Nobody's been rejected. We've managed it very well.
Interesting, very interesting. I've seen, I haven't really seen a lot of rejections on gold, at least in the retail market, but I've seen slippage. But again, around news, I mean, slippage is slippage around news, I would say, right? You mentioned, you guys do stress tests. You guys are constantly looking at internal data, looking at the flow that's going through, let's say, Scope Prime or Rostro more globally. Is there any data or observations that you've looked at recently that can sort of help us understand what's really happening in the gold market behind the scenes in the industry? And are there any, let's say, patterns that you're seeing with respect to gold trading? Maybe to phrase the question this way, like, this is something that I posed to someone after Trump announced his tariffs, right? I guess it was
April, yeah.
in April, right? And sort of the market reaction right after that, right? It seems like after the market movements back then, people kind of took stock of that and were like, okay, in terms of risk management, in terms of on the institutional side, being well capitalized and all these things, it kind of taught brokers a lesson. What are you seeing in terms of the data and sort of the observations that you're seeing on a daily, weekly, let's say monthly basis? Is there like different trends forming within the gold market and within the industry?
We're seeing and hearing a lot of things about a lack of physical gold to actually deliver from the LBMA into COMEX. We're seeing that China have recently been rumored to have bought a hell of a lot more gold than they published, maybe up to 10 times as much.
Wow.
So we have a lot of theories around this, and there's a lot of rumors going around that there's nowhere near enough gold to deliver into the next futures contract, which causes a knock-on effect, because people have to come in and physically cover their gold again,
Yeah.
or financially cover their gold.
Yeah.
Some countries have now said they're going to take delivery outside of COMEX and maybe use deliverers in Asia to
Uh-huh.
cover deliveries, to cover the shortfalls. So it could be a big liquidity squeeze if we're not, if things all line up correctly,
Uh-huh.
we could see a bit more of a squeeze here in physical.
And what would your suggestion be if you or someone or a company that believes that could be a potential risk in the future? Like, what do you do?
I mean, for us, like you said, there's there's lots of brokers that offer higher leverage, much higher leverage than what we would ever offer. For the company or a broker, it's about protecting yourself,
Mm-hmm.
like making sure that you don't have an inventory that is above your balance sheet, making sure that you have top tier LPs that you can leverage out to and you can hedge with.
Yeah.
It's about protecting yourself and making sure that you don't be overly concentrated to one product or one group of clients.
Mm-hmm. Interesting. Okay. Given everything that we've said, let's say the one directional flow of gold so far, leverage levels, and again, we could say the thin capitalization of some brokerages. We don't know which ones, etc. It all depends on each individual company. When you speak to LPs, the top tier LPs, what are their concerns in terms of credit risk, and counterparty risks in all of this? Because I mean, they're another piece of the puzzle, if I could put it that way.
Yeah. I mean, we always choose our counterparties very carefully.
Hmm.
A lot of due diligence done by the risk department, checking balance sheets, checking financials, stress testing our own balance sheet with them. Um, I think you're right. If you was to look at a gold chart, it should have been an easy year. It's just gone one way. You should have just been able to sit there, buy and hold it, and everyone could have done okay. But
Yeah.
the movements in between these quick up moves, the volatility that gives a snapback very quickly is what catches a lot of brokers out as well. And clients obviously want to withdraw as soon as they made a big amount of money. So you have to make sure that you have enough house funds available at all times. You have enough funds at LPs at all times. And even our LPs or liquidity providers and brokers, they stress test downstream to us. They want to make sure that they're fully covered. And I think one of the biggest issues that you see with a lot of brokers is the offering of too much credit.
Hmm.
And credit is a thing that, it's not a problem till it's a problem.
Well, that was going to be my next question is, do you think that some brokers don't realize how close they are to, at some point, being cut off from their LPs? Because that is something that does unfortunately happen. I mean, there's only so much credit or so much of a lifeline that you could be provided with, right? I mean, again, given the situation, given the market, and given volatility.
If you're a smaller broker or a broker with a smaller balance sheet
Hmm.
and you're giving credit out to your underlying clients, you're waiting for them funds to land with you. You're sending the flow upstream to a bigger LP who's obviously giving you credit. You're reliant on your client giving you his funds so you can fund your LP. It's a bit like robbing Peter to pay Paul,
Paul. Hmm.
and it's not sustainable when there's a big move in the market. Now you have a 3 or 4% move in gold. Everyone's the same direction, or everyone will be the same direction, and the stress it just builds and builds and builds. And yeah, a lot of brokers will come close to getting stopped out, especially if their underlying clients are filled with credit and they haven't got the funds in yet. You can't fund your upstream LPs, and it's just a knock-on effect, really.
Yeah, what would happen in that case? Just from you have a deep understanding of the market and how this would work. If there was something like that was to happen at a brokerage, like I'm just as a layperson wondering, like, I mean, would they have to cancel all the positions and basically annul any results? I mean,
It's hard to answer in one way because I've been at brokerages before where there's been a mistake or an accidental stop out.
yeah,
And if you have thousands and thousands of clients stopped out that shouldn't have been stopped out, it is such a laborious task to go
uh-huh,
back to reopen every position, recalculate where it should have been, work out what trade should have been stopped out, what one shouldn't,
yeah,
get the funds back into the right accounts. It can take days and days and days. In the meantime, when the market's busy, you've got fresh new orders coming in
of
and fresh
course,
new
of course,
trades.
of course.
So business as usual carries on, and you've got probably 3 days worth of work to undo an accidental stop out or a stop out because there was not enough funds there. It's very problematic for a broker,
Sure.
and we avoid that and make sure we have measures in at all times to make sure this never happens.
Hmm. I wanted to sort of flip discussion a little bit. We've talked about the institutional side, the LP side of things. What about traders? I mean, again, where's a lot of the demand coming from? It's coming from retail traders because they're looking at the price, they're seeing it basically just keep going up, up and up. Obviously, it's volatile, but still, long term, they're seeing it. The price go up. It's a risk off asset, right? It's always been traditionally. And again, if we take a look at what physical gold is, right, it's a monetary instrument, right? It's a form of exchange. And we have the US dollar, right? And then we have gold, right? Arguably. Those are the two main instruments of what do we call it? Commerce or exchanging, right? Some kind of monetary value for goods and services, right? What about the trader? How, is there a practical way for them to essentially kind of stay safe in this environment? Again, It could be a sophisticated trader, someone who knows what they're doing, who does technical analysis, who does fundamental analysis. And let's say somebody who's well capitalized themselves. Let's say they're not trading at 1,000 to 1 or 500 to 1. Let's say they're trading at a reasonable leverage and they have to maintain a significant amount of margin on their account. Is there any way for them to reliably protect themselves in this environment? Again, you can always trust your broker and open an account with them and trade if you're a retail investor, or let's say professional investor, even as they call them or term them in specific jurisdictions nowadays, right? Where they check how much capital you have, how much experience you have. Let's say you are one of those people, but in my mind, like, you might be trading with a brokerage that's been around for 20, 30 years. You just don't know, right? What could happen again in this environment, right? Where everything kind of, like you said, if it all comes together in one day, in one moment, it could essentially kind of blow up. And what's the retail trader? How do they protect themselves from either something like that happening or minimizing their exposure to something like that happening with their broker?
I think you've hit the nail on the head with leverage. Leverage is one of the things that you have to keep, you got to be mindful of.
Hmm.
Hence why the exchanges charge a hell of a lot of higher margins. So I think knowing the product, knowing, the volatility of the asset you're trading, knowing how much it can move per day. As you say, some traders do technical analysis, some are fundamental. But I think just making sure you're not over leveraged, you're not over trading, you're making sure that you're trading at the right times. You're not going to the market looking for trades. You're waiting for a setup that you've got planned.
Yeah,
And I always think with a trader, I've been a trader for 30 odd years now. I think you have to plan your trade and trade your plan. And if you do that, you're giving, the odds are in your favor slightly.
sure.
And I think just making sure you're with a reputable broker that has a sufficient balance sheet, that is sufficiently capitalized, trustworthy. And I think just keep away from smaller brokers who are unknown and not known.
Even if they're giving you like some sort of incentives or some kind of, let's say, account setups that you might find attractive, so to say, just to reel you in as a retail client.
Yeah, because you got to think if they're doing that for you, they're doing that for thousands and thousands of other clients.
Hmm.
And I always say to when I have conversations with our big institutional clients, and I explain how we do the risk and how we manage the risk, how we, um, all the processes and the steps we do, value at risk, volatility stressing. And I always say to these guys, we do all this and we're quite stringent with it, which gives them comfort knowing that we're doing this to all of our clients.
Hmm.
Sometimes it might make us it causes a problem sometimes because people want unlimited risk or you know bigger risk limits than what we think are suitable.
Yeah.
But it just shows that we care and we're monitoring this and we're making sure that all of our clients are protected. As where I think a lot of other brokers, or as you say, they offer high leverage incentives, all different ways of enticing you in. But ultimately, you want to know your capital's safe and that it's being well managed.
Yeah, absolutely, absolutely. Probably going a little bit off topic here, but if we talk about the retail side of things, I come from a background where I've seen a lot of bad actors also in the retail space. And I'm wondering, you're obviously more on the institutional LP side, but I would think that some of this, I think in your world, it's called toxic flow, so to say, right? Is there anything happening on that side in the gold market? Because again, there's volatility, there's so much interest, right? There's so much volume going through it. In my mind, it might be like a ripe environment for bad actors as well, because you've got so many orders coming in, brokers having to execute a lot, those going upstream to companies like yours and to LPs and etc. Um, a lot of times I've seen these situations where it's a ripe environment for some of these bad actors to slip in and do something. They obviously can't manipulate the market from a price standpoint. I don't think, right? They won't be able to move it. But again, they might be doing something where they're using some sort of predictive trading models or whatever it may be. Or again, somebody's going long, another person's going short, in very high volumes or something like that. Is that something that is still of a concern? Do you think, you know, going from retail to the institutional side, LPs, execution, and all that. Like, is that something that's prevalent within the gold market as well?
I think, yeah, definitely. I mean, it's prevalent in all of the markets. I think, but gold, especially as now there's so much more volume,
Yeah.
it slips through a lot more because you've got so much more to monitor, so many more trades, so many more clients. But we have very good systems in-house. We have in-house written systems that monitor for toxic flow, latency, markouts, decay. We also have a team monitoring these from reports that they get, every 15 minutes. We have systems in place to catch this as well. A lot of the stuff we want to make sure we protect our upstream LPs as well.
Sure.
If we're being hit on toxic flow and it's going straight to an upstream LP, it's harming them as well. So we normally pick up toxic flow well before it's even got to the next LP. We're very, very hot on it. Our team is actually quite amazing to pick up this flow. But you're right, it's not just the latency arbitrage or spot versus future arbitrage. There's a swap arbitrage as well, which can harm a lot of brokers because it gives an unnatural position either on their internal book or their external book. Swap arbitrage is always going to be a thing, especially with financing rates being higher. It's quite attractive and lucrative to have a swap-free account and a swap-enabled account, an arbitrage between the two.
Mm-hmm.
So we do see it and we spot it very quickly. I'd like to say probably we're one of the best at spotting this, and it doesn't really come to us that much because clients just know that we won't entertain the
Yeah.
toxic flow. We're fine with algorithmic trading. We're fine with systematic trading, but if it's blatant predatory trading, it's not welcomed anywhere really.
Yeah. Right. Mm-hmm. Although there is a well, they call themselves a prime broker. I'm not sure if they really are, and I'm not going to mention any names, but I did see this somewhere where um, a person that I know now leads up this prime brokerage or LP, and he said we will take toxic flow. It just depends on who it's from.
Right.
So I don't know what that means.
Yeah, I'm not 100% sure on that, but if you advertise and some people do advertise, we'll take higher frequency and
Uh-huh.
latency arbitrage. That's fine until they get so much of it and it ends up hurting the broker.
Mm-hmm.
Then, are your funds safe for that broker then? Because, can they pay out? Can they can't sustain taking toxic flow for a long time.
Mm-hmm. Mm-hmm. I wanted to kind of move the conversation out a little bit globally, macro level, and talk about just in general the gold market structure. You mentioned China and the fact that there are rumors that the amount of physical gold that they've bought up over a certain time period may not be what they're publicly saying, right? They might be holding a hell of a lot more, and that could be other countries as well. Indonesia, they just announced tariffs on gold exports, right? And I guess I would argue that the backdrop today is that other countries might do so as well, because again, like you said, there's a need for physical delivery, and there's just not enough of it. There's obviously a lot of gold probably also in private hands, right? Whether it's private banks or wealthy individuals, whoever it may be, besides global governments, right? And let's say central banks and things like that. Um, you as a professional in this market, I guess I want to ask you, could we see a what I would call a backwardization of gold, where spot prices at some point trade above futures, and kind of like, what if that happens? Could that happen? And what does that really mean for brokers, for retail traders, and for risk desks and hedging and everything in between?
Yeah, I mean, you could see backwardation in these products. I think gold and silver. I think silver has a similar problem to gold,
Mm-hmm.
where there's even exchange traded funds. The failure to deliver deliver rate has gone up recently, where people can't make delivery. They'd rather pay the fees and
Of silver.
you have silver.
Uh-huh.
So that's having a more of a knock-on effect at the moment.
Uh-huh.
Definitely in gold as well. As I said earlier, there's shortages of trying to physically move gold to where it should be.
Yeah.
Um, I could see a bit of a squeeze if this was to continue
Mm-hmm.
and the price keeps moving up. I think we will see a bit more of a squeeze and liquidity. I mean, liquidity on COMEX is very deep. So if you look at the underlying futures, there's so much liquidity there,
Hmm.
but nowhere near as much as the liquidity needed for lots and lots and lots of CFD brokers to hedge onto the exchange. The liquidity in the real market isn't as deep as the liquidity offered out
Yeah.
by multiple brokers.
Hmm. Interesting. I guess one of my last questions is, the price just keeps going up, up and up, and it's obviously past historical highs, however many times, right? Um, and then I look at markets like Bitcoin now, right? Again, yeah, digital assets, cryptocurrencies, etc. The price of Bitcoin, where people think it will go, and things like that. But then I'm also thinking about gold as a traditional, like we said, it's a traditional asset. It's also a means of monetary exchange between us, etc. Like, what would it take for the price of gold to actually turn around and and you know and fall? I mean, do you think that we're past anything like that? We're sort of like on a global macroeconomic level. We should be, um, let's say, kind of take the price of gold for what it is and not expect it um, to basically turn around and let's say go down to the levels that historically it has been trading at. I mean, look, when I started in the industry, the price of gold was like $1,300, right? That's a hell of
Hell of a lot higher now.
that's a hell of a lot higher now, you know?
Yeah, I mean, the cost of production back in 2023 was around $1,600 an ounce then.
Mm,
So, it can't go below cost of production,
sure.
and cost to move it and store it. I think, and from what we do a lot of research on this, it's in a new area now. It's in between the sort of 3,800, 4,200 sort of area. We are in uncharted territory, so nobody really knows. I don't see anything in the very near future to correct this. You've got interest rates coming down globally,
Yeah.
slowly, but globally they're coming
Uh-huh.
down.
Uh-huh.
Still have unrest across the world in certain areas. I don't see any drivers that will let gold slip lower. I
Uh-huh.
think
Uh-huh.
there's drivers for it to possibly move higher and definitely stay in this higher end of this range for a long while.
Yeah, yeah. Interesting. Cool. Another last question. You mentioned you have different algorithms, you have software, you have people running models, like you said, twice a day, stress tests, and all of this. I gotta ask, are you starting to implement machine learning AI into any of these systems that you use? I feel like a lot of companies in your space that I've spoken to um, earlier this year are saying, yes, we're starting to kind of use LMMs and whether it's our own proprietary stuff or we basically take something that exists and code it to our needs, and we basically run a lot of these models, do a lot of this analysis in automated form, and then basically, but then have a human basically sit there and evaluate the results and take any kind of action that needs to be taken. Is that something that you guys are also either implementing or using as well? Because that seems to me like that is the future. Ultimately, there's still a human there to basically evaluate and make a decision, but a lot of these sort of rudimentary processes that used to take place in Microsoft Excel with an API connection.
Yeah.
Um, are now done through much more sophisticated systems.
Yeah, we have a new quant team. They've been there probably just over a year now, building that quite quickly, and they are doing a lot of AI and machine learning sort of capabilities and technology behind it. A lot of it's in-house. We have some systems that we use, and then, as you say, we take a feed from and we create our own reports. But we are doing a lot of this stuff in-house now. We have a big team of developers, probably 25 developers now. So automation for us, not just on the risk side as a company, we are looking at making a lot more automation in every department.
Hmm.
So less error prone, less manual work, a lot of time saving. Time saving is cost saving as well.
Hmm.
But a lot of the stuff we're looking at now is for efficiency,
Yeah.
and automation is the way forward.
Hmm. Great. Awesome. Last question. You told me you're a Londoner yourself. You're from the UK, but I'm venture to guess you probably traveled to Cyprus already many times,
Yeah,
but you probably also traveled to Dubai as well and other countries. But when you're very young, but when Saul does retire, would Saul consider retiring in Cyprus?
yeah, definitely. I love the Mediterranean. Cyprus or Spain for me,
Great.
definitely.
Well, Saul, thanks for letting us pick your brain. I know you're very busy, you just flew in.
Thanks for having
But
me.
thanks for giving us insights on the gold market and what Scope Prime and more largely Rostro is doing. We hope that the gold market stays stable and we don't want massive liquidations or a shortage in physical delivery, but we'll see what happens. It's a very interesting topic. I'm sure you and I will continue to discuss this maybe even into 2026 as well. Thanks for joining me.
Lovely. Thank you.
Cheers.